This is Ruxandra, co-founder of Pabele, and I'm here for our 8th session of the Investment Readiness program regarding valuation. This session is central to our Investment Readiness program because we are talking about the value of your company, and it has a huge influence on the money that you're going to raise, on the ownership that you are giving up to investors. And so it is just a very small introduction. You should check out different methods because there are many valuation methods, and you should be aware that it's very sensitive to different inputs. So there is no precise science. It's more a question of a negotiation between founders and investors. And of course, founders are going to want to have the highest valuation possible because they want to raise more money with less dilution. So they want to give less equity to the investors. And on the other hand, the investors are trying to have a low valuation because like this, they can have higher returns on their investments in the future. So we have conflicting interests, and we have, on the other hand, various methods that are very sensitive to the inputs and assumptions that you are making on what the company is going to be worth in the future. So this is why it's important for you to know the different valuation methods and to know what are the important factors for an investor. It is also important for you in order to make good educated guesses about the value of your company because it has an influence on everything else. Today, we are going to talk about the different factors that have an influence on the value of your company, the different valuation methods, and we are also going to talk a little bit about pre-money, and we are also going to mention pre-money valuation and post-money valuation. The factors that are influencing the valuation of your company. Of course, all the sessions of the Investment Readiness program that we have conceived until now are going through this. So you're going to see the different elements that we have already talked about in the past. So we mentioned, for example, traction and how important it is to prove that you have traction. It has an influence on the value of your company. Having already active users, moreover, having an efficient marketing, having paying customers, this has an influence on the value of your company. Also, when talking about valuation, investors take into account your team. This is why we had a session on your team. They look at how skilled the team is. Are you covering all the necessary competencies? Because this ensures that the team is able to deliver what the company is aiming for and can create the value that is needed in the future. Of course, investors also look at the trends in the market. So is this growing market? Are there many competitors? All this has an influence also on the value of your company. And as we mentioned in the past, and as we are going to mention in this session as well, they are looking at comparable startups in the market, how much they have been valued, and they are comparing it with the value of your company. And of course, what has an influence are also the margins. How much return on investment can they have? And that has an influence on the valuation of your company. Because in the end of the day, they are putting in money in your company and they want to have return on investment. So the margins are playing that role. There are different valuation methods if you are at the very early stage and you don't have revenue yet, or if you already start to have paying clients and you are at post-revenue. Of course, the valuation methods are increasing in complexity. There are different ones. One of the most famous startup valuation methods is the Berkus Method because it's the easiest one and the fastest one. And it's also the one that I'm going to talk about in our session today. Then you have the scorecard, which is the Berkus Method with additional variables inside. Risk factor summation, venture capital methods. We are not going to talk about them in this session, but you can search them online. And it's good to be educated in the field so that you know these methods. And for post-revenue methods, I'm going to present here the discounted cash flow method, but there are also the comparables ones, which I'm going to mention. And first, Chicago. So my advice to you is to go online and search for the other methods so that you know what they are when you're talking with an investor. So the Berkus method was conceived in the 90s by Berkus, who wanted to have a way to value startups without depending on their forecasts. So he realized there are mainly 5 factors that have an influence on the value of a company. And he said, okay, so I'm going to say that if a company reaches 20 million revenues in 5 years, more or less the maximum company value now, it's 2.5 million. So in this case, I'm going to put 0.5 million for each one of these factors. And the factors are, the idea is sound. So there is a basic value there. There is a prototype. So there is a lower technology risk. There is a good management team. So there is a lower execution risk. There are good strategic relationships. So there is a low market risk. And there is a good product rollout or sales. So there is not a big production risk. So there is a maximum of 0.5 million for each of these values, reaching to a maximum of 2.5 million. And then for each of these factors, you look at the startup that you want to value and you say, oh, so the prototype is not that good. So instead of 0.5, I'm going to put 0.4 million. Or there are no strategic relationships. So instead of 0.5 million, I'm going to put 0.1 million. So then by summing up all of this, you can arrive at the maximum of 2 million instead of 2.5 million, which is the maximum that you can reach with the Berkus method. Of course, the method is very simple, doesn't take into account if it's like more than 2.5 million valuation. And there might be other factors that also have an influence, or in certain industries, some of the factors are more important than others. So these limitations are reached with the scorecard, but I invite you to check it out afterwards. Here, I just wanted to mention one of the post-revenue method, which is one of the most known one. It's called discounted cash flow method. It's very easy to understand. It's the annual cash flow generated for each year that you discount it at today's money. So the cash flow from next year, you discount it with the discount rate this year. The one in 2 years, you discount it twice, and so on in the future until you reach a terminal value. So it's very good if you are able to foresee the cash flow that you are going to have in the future and you can be precise with it. But being in a high uncertainty, it's hard to be very precise on the cash flow. So there you have educated guesses. Also, it depends on the discount rate, which discount rate you are going to choose. So it's a very good method in order to show to the investors that you are able to foresee how much revenue you're going to make. So then you can also foresee your cash flow, and it's a good start of discussion, but it's hard to have a precise valuation method, especially in the beginning of your startup years when you don't know exactly how much cash flow you're going to have in the future. Finally, talking about words that are very fancy. It's important to understand the difference between pre-money valuation and post-money valuation. You hear that around a lot. So pre-money valuation is how much is my startup worth right now before I raise the money. And when we are talking about valuation, usually it's for the pre-money valuation. But then you also have post-money valuation, which is the pre-money valuation plus the cash raised. And it's usually higher because through the cash raised, you can invest it and grow the value of your company through that investment. So it has an influence, the money that you're raising, on the valuation of your company. That's what I wanted to present today. I'm looking forward to see you completing the assignments, and don't hesitate to reach out if you want to have additional information for the investment readiness program.